Hello, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Technology's Role in Trucking Industry Succession Planning. We're pleased that you've joined us today, and before we begin, I'm going to play our brief housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I would like to introduce today's presenters. From Moss Adams, we have Terry Dickens, partner, and Jesse Proctor, senior manager. We also have Hans Galland, CEO and founder of BeyondTrucks. All of their bios and contact information are located in your webcast console for your convenience. And now I would like to turn the floor over to Jesse to get the presentation started.
All right, thank you so much, Amy, appreciate that. And thank you everyone for attending today's webinar. We are very excited to be able to spend this time with you sharing about technology's role in succession planning within the trucking industry. Today's webinar is actually a result of a joint guide that we collaborated with BeyondTrucks which focuses on important aspects within technology, finance, and accounting and tax to consider in preparation of a successful transition of a trucking company. And at the conclusion of today's webinar, we will be able to share a copy, a link, and provide a copy of this guide with you as well. So we'll be able to, you'll have that at the end. But again, we appreciate everyone's time being here to be with us, and we look forward to hearing from you. If you have any questions throughout the cadence of our webinar, there is a question and answer section here that we're happy to take and be able to talk to as we go through. And as you can see on our agenda slide here, the webinar will be short, but it will be sweet. We will first start with discussing the end result, which is by sharing some of the basic building blocks about understanding how much your trucking company might be worth. We'll keep this discussion brief, but it is important to understand that there is a lot which goes into the value of your business, and we strongly encourage you to work with a specialist to dive into the specific facts and circumstances of your company. And then we will jump into discussing what are some options to transition your trucking company, and then discuss what finance and accounting, tax and technology preparation and strategies should be considered as you go through this process. So I'll turn it now to Hans to share.
Thank you, Jesse, and hello, everyone. So when we think about our trucking business, it's important to understand what drivers influence the value that your trucking business achieves in a sales transaction, or even if you hand it over to the next generation in your family. So by definition, what is value? Value is really the fair market value that your company would achieve in a transaction. And that would be the price at which a willing buyer and a willing seller are engaging in a sale. So what does that mean? Value is actually essentially a transaction price. So what do you need to do to influence that value in a transaction price and still have a successful transaction? Essentially, the buyer needs to understand that by buying the company, they get a deal. So there needs to be a perception of value that by paying for the trucking company, there's more value in the business than what they're paying for. At the same time, as a seller, you obviously do only want to sell the trucking company if you sell the trucking company at a price that makes you happy, and you believe that the sale is a good transaction for you. And that's where both the seller and buyer need to come to an agreement that from their perspective, it is a good deal. So what does that mean? As a seller of a trucking company or someone who's exiting a trucking company, very critical for you to understand how buyers perceive value in a trucking company. And it's very important for you to prepare the trucking company, the trucking company's optics in a way that you maximize price in the perception of the acquirer or the party that takes over the trucking business. How does a buyer look at the appropriate price of a trucking company? Well, there's essentially two parts of that equation. The first one is income, or how much money can the buyer of a trucking company make by acquiring the business. And the second part is risk, is how likely is it that income will actually be realized. So understanding both income potential and risk are really, really fundamental in thinking about how do you improve the optics of your business in the eyes of a buyer. I'll pass it to Jesse, who may have some additional comments on the notion of value drivers and valuations.
Yeah, I think back to my finance class, and I'm always told that your value today is the present value of all your future cash flows discounted for risk for today. And so as you think of what drives ultimately the value of your company is, it's going to be what generates your cash flows, your customer contracts, it's the costs, it's your efficiency to kind of create a net positive cash flow. And that risk piece, right? Like what risks are there and present in your organization, and understanding those. And to the extent you can dive into and really grasp those risks and know how to maximize the income and how to reduce the risk, those are the things that ultimately kind of result in a more valuable today value. I'll pass it back now to you, Hans, as we go into some of the methodologies maybe here.
Wonderful. And then a second note on what you just mentioned, Jesse. Also often companies come to us and say, well, the market is down, I want to exit. Well, that's a fact that everyone in the market, also the buyers, also know. So it's very critical to bring information to the market that the market doesn't know. So it is informational asymmetry, so to speak, between the buyer and the seller that you can leverage in the marketing or sales process of your company. In terms of valuation methodologies, and again, to Jesse's comment, you should have a professional conduct that exercise, but it's interesting and valuable to understand what different methodologies exist and how you as a seller can influence the perception of value in the process of engaging with a buyer of the company. So the first one is the discounted cash flow methodology. And in a discounted cash flow methodology, you will be projecting some form of income. It is usually EBITDA, or it could be free cash flow, that reflects the future income level over a period of time, say 5 to 10 years. And that projected cash flow will then be discounted back to the present using a discount rate. And that discount rate, as Jesse mentioned, reflects the level of risk. The level of risk that the company's cash flow will be exposed to. So in that process, it's important to highlight certain initiatives that you will conduct over the 5 years, or the buyer can conduct over the 5 to 10 years of the projection period, that will improve income, or certain aspects that will certain activities that will improve the sustainability or the achievability of those cash flows. So it's being very, very mindful of those initiatives over the period. The discounted cash flow methodology is particularly important or valuable if there are certain strategic activities during the 5 to 10 years that don't just project a normal level of income. Let's say you see an opportunity to launch a brokerage business in addition to the carrier business. That potential can be projected in the 5 to 10 years that the projection period encompasses. Jesse, any thoughts on the other valuation methodologies?
Yeah, the discounted one I think is like that's the finance 101 one that I think I was referring to, and then the other pieces here, in my experience, is you have to go through all of these to figure out some combination, an average of it lands about where your valuation is. And I think the other one that we have listed is this asset-based one, and this one thinks to me of like you have a terminal, you have a warehouse, you have a fleet that is maybe strategically located in a region or a market for a buyer, and maybe that's pretty valuable to them. Or perhaps you have a trademark or a trade name that's very important to a buyer, and they're looking at what is that replacement value to build that warehouse, to purchase that fleet of trucks that is there to be able to get those tangible assets or to acquire that intangible asset. That's that's another way that a buyer is going to look at what they're buying, as well as is outside of just the future cash flows, like what are the assets that are coming along with it. And then the last one that we have listed here, and this is the one I feel like is the most common, and when you're having drinks or talking about with your friends, everyone's like, oh, did you hear about the multiple, or this person's multiple on EBITDA, or their revenue multiple. This is the one I feel like everyone likes to reference or talk about, because I think it's just the most simple way to really have a tangible way of what your EBITDA is. You don't have to have a finance degree to know how to discount cash flows, but it's important to note that multiple from one, just because your friend's trucking company got a certain multiple doesn't mean that's the same multiple that your company's going to have, because those multiples kind of go back into what Hans said, like it's income and risk. And so each company is so unique and so different that those multiples are going to fluctuate from, what similar companies to, within the same industry. But it's a great way, at least, to kind of put the thumb up and kind of get an idea of like what might my company be worth, is looking at like what are some common multiples for my industry, and just know that it's going to be dialed up or dialed down based upon your risk factors, is how I think of these other methodologies there. And this, again, I think when going through this process and you have your valuation specialist that you're engaging, is incredibly helpful to you to understand the value. But while we didn't get into too much depth here, these are important aspects to understand, so that when you have a conversation with your valuation specialist, these are the building blocks and where they're going to start with and to dive into. So it's important for you to understand these as business owners. And secondly, it's important for you to know that your industry is unique, and it's strongly recommended that you engage with and work with specialists who understand your industry, from that be on the valuation side, or as you go through this whole process, that you want to work with someone who understands your trucking industry. So I'll turn it back to you, Hans, and we can, for any more closing thoughts on some of these methodologies.
Thanks, Jesse. Yes, absolutely. I do think it's important to always keep in mind comparables for the methodologies, because they do become the basis, the sanity check that you should do, and the appraiser will do when determining. So it's not just a financial model; it's actually you need to have market evidence to substantiate the value that's being calculated. Good. The next section is really much more practical advice when we talking about a generational transition, and how generational transitions can be structured differently as we go through the process, and how to prepare the actual company for a transition. I'm going to pass it on to Terry briefly for a comment on ownership transitions.
Yeah, so when transitioning a company, you need to look at both the ownership, the legal ownership, and then also the operational transition. For ownership transitioning legal ownership, you kind of have the choice of, do you want to keep the company in the family or transition it to an outside party that's not a family member? So if you're looking at transitioning to a non-family member, typically it's going to involve selling the business to a strategic buyer. That may include like a private equity firm. That can include key employees. It could be a customer. It could be an ESOP to your employee stock ownership plan. There's quite a few options when you're thinking about selling to an outside party. Also, and then if you want to sell to or transition it to a family member, you have the option of selling to the family member at fair market value, or you could gift the business, and typically that's going to be to a family member, although you could technically gift it to a friend, but typically see with the gifting to a family member. And it's important, and we'll talk about this a little bit later, each of these unfortunately don't come free from a tax perspective. So the taxing authorities do want their share of this, and we'll get into the tax implications a little bit later. So I'll let Hans talk about the operational transition.
Yeah, the operational transitions are probably the most complex and more art than science generally. What we see with operational transitions in trucking companies, and especially family-owned trucking companies, is that the challenge lies in the family essentially having three roles: being operator or manager, being owner, and lastly, being family members. And many of the frameworks that we use in non-family owned companies may not apply from an operational perspective, but there's some frameworks that we can reference to put some logic or some structure around it. So I think the first thing is to consider is, how do you operationally pass on the baton? Essentially, who's going to run dispatch? Who's going to run safety? Who will do HR? I think that's it's much more tactical decision, but certainly there's an operational decision process in there, because mostly a lot of the knowledge is captured in the owner's or the founder's brain, and that needs to be exported for the company to be sustainable. And we touched a little bit on how technology can help in that, but technology can be very, very instrumental nowadays in passing on operational expertise, standards, controls to the next generation through the use of what we call smart automation or intelligent automation technologies. Building visibility is very critical. Build visibility in terms of data performance is really the source of trust amongst all the family members and owners involved. So visibility from a data perspective is very, very critical. Moving off paper, moving into digital data, very fundamental. Management control. So the separation of management and ownership is something that some companies or some families will need to think about, is who can make what operational decisions in real life. So for instance, can the general manager take out a loan for the business? Or is that something that really ownership needs to decide? What is the wire limit on wires for payments out of the company? What's the approval process? Is that a CFO decision? Is that an owner decision? Or is that a general manager's decision? Set a management controls for managerial decision making. And then lastly is governance controls. Is really the ownership, the last instance of ownership control, certain decisions, critical decisions that only ownership can make at the board level to decide. Now, that could be a sell of the company, again, financing of the company, or certain large wire transactions, for instance, that you want to carve out for the board to have a say, to truthfully make a decision on those things. So using that framework of governance, board level controls and management controls, and formalizing a structure or a matrix or a document that summarizes them is very, very critical. And it can build a lot of visibility and trust in the actual process. We'll continue with some finance considerations next.
Thanks, Hans, Terry, for talking us through some of those transition options, and agreed. And now from a kind of talk you through questions to think about as you are preparing from an accounting and finance side here. There's a few bullet points here, and I guess the first spot that we think of when I am starting to work with a client who has grown from a small business, they've gone to more mature, and as they go to like now want to look to sell or kind of take their business to the next level, like the first kind of order of events I think of is I start to try to ask and understand, well, what does your financial close process look like? Because I think there's are you even closing the financial statements? Do you close them? Most of my clients, they say that they just try to do it really annually, and or that's where they start off with, and we say, okay, well, we got to get better. Let's start with quarterly, and then let's get to monthly, and because those are important aspects of a buyer. They're going to want to see how disciplined your accounting team is and how disciplined your organization is to be able to produce financial statements on a recurring systematic basis. So understanding what disciplines you have in your accounting team to produce financials is an important first step in understanding what are some roadblocks there. The second step, as I start to think of financial reporting, is, do you have non-GAAP policies? It's very common that there's a pseudo okay, I want to keep this method for taxes because that's what I do. A lot of my personal life choices are based off of tax reporting. Is that necessarily related to appropriate for GAAP? And understanding where there might be disconnects between your current accounting policies and what GAAP might allow for and have. And so starting to, again, understand that process and what those the disconnects might be. It's important to understand within your statements as to what's within them. Are there one-time costs that are unique? Knowing how to highlight that, thinking back to when we think of that valuation process, like what do you need to normalize? Did you have one really good year because you sold maybe you sold a few trucks in the past 12 to 15 months, and you got some pretty good gains that come through your financials. Highlighting that and making sure that you've highlighted that so that, hey, this is maybe going to be recurring, or likewise, perhaps you've paid out some big bonuses over the past 12 to 24 months because your team has been working really hard to keep the supply chain moving forward. And so highlighting those non-recurring bonus and those costs are going to be an important way in understanding what those are, so that you can build those into your pro formas and be ready to be able to communicate those to a potential buyer. Stepping outside of and then lastly, as you progress along, are you doing reviews annually on your financial statements, or are you being audited on an annual basis? And understanding that, and that goes and communicates and says a whole lot to a potential buyer to show that you're, hey, like you're sophisticated enough and you can produce, again, GAAP compliant financials and are able to generate these, and you have some level of assurance as to the completeness and accuracy of your financial statements. That helps provide a lot of comfort to your potential buyers. Taking a step back from the financials, we think of, okay, what risks exists in my contracts that I have? I think of, are you able to easily assign and move lease agreements for your terminal, for your warehouse, for your trucks, your trailers? Like, what do you understand the ability to have those move around? Do you understand your revenue contracts sufficiently to be able to understand if how might that move from you to a buyer if they were to get that company? Understanding, are there clauses within them that might prevent or cause an issue? What does your line of credit or your debt agreements say, or what are your financial covenants that you have, and how do you track and monitor those types of things? Like, have you taken time to really dig deep into those non-financial contracts that are important? And then lastly, like, this idea of a sell side quality of earnings is the all these things I just talked about. Like, as you engage again with that valuation, that's a specialist here, an investment banker, and that helps you go through and create a sell side quality of earnings. Like, the ultimate goal of that whole process is everything I just asked you about and said, are you thinking about these or what have you done? Those are like, each are a step within that process with the ultimate goal of once you've gone through this, you've created a workbook, you've normalized your earnings, you've identified all the things out there, you've reviewed maybe some of the riskier areas, which could be related to your state and local tax issues. Have you looked to see where all your trucks are going, and have you made sure you're filing appropriately in each of those municipalities and localities to make sure you're being compliant? It's going to guide you through all these questions with the end goal of once you're ready to go to market and you start to approach buyers or buyers start to approach you, you want that process to be as smooth and as efficient to go from starting that discussion to the end. And you want to do your best to avoid any surprises or unexpected answers as the buyer comes in and starts to look. And so the sell side quality of earnings is really the kind of like it's the preliminary work, and hopefully the goal is to capture everything the buyer is going to want, so that way when they come in you can just say, hey, here you go, here's the data room, here's all the information, we've looked at this information, it's been through it, and it makes their process go faster. So it makes the timeline from the engagement of a buyer to a close to be quicker, and presumably it's met and avoided all those surprises along the way, because you kind of came out and you found out about these during the Q of E sell side process. And then I guess I'll pause. I know we talked about Hans, see if any other team members here have any thoughts, comments if they'd like to add before kind of look at kind of the proposed timeline that we have, but I'll see if anyone else has any comments to add on that. All right. So here, this is small, it's hard to read, but again, I think we'll share a copy of the slide deck afterwards. The things that we just discovered, if you look at this bar, the top portion of this is going to be, it says business, and those are the finance consideration pieces that we just talked about. And here in this example, it says 180 plus days prior to the transaction date. It assumes at this point that all those finance considerations we just talked about, that sell side Q of E, that's assumed to have been done and completed essentially by the time you're at this 180 days. So like that furthest left column is not when you start the sell side Q of E, it's not when you start to ask understand your financial close, understand where your risks are. Like you've kind of gone through this process and now you have your sell side Q of E and you're ready to go to market and you're ready to move it forward. And so this is just wanted to highlight it takes time to go from being ready to the actual transaction date. And there's certain key aspects and milestones along the way that we hit here related to when to start to think about when should certain things be happening and when should you be thinking about it, so that way when the buyer is asking for it, you're kind of in that right spot where it should be. The lower portion of this timeline are personal items, and this is going to get a little bit more into what Terry's going to share with us here soon about asking the questions about what do I need at the end of the day for this transaction? What are the goals that I have? What types of planning do I need to do to be able to adjust to a lifestyle or adjust to a post-sale transaction, and being able to talk through those pieces, because just as much as you're having like the business piece, there's a bunch of personal side and planning that you need to do from your state side, tax planning. Again, those are things that Terry are going to share with us here shortly. But wanted to be able to put this up here just to show you that here's a proposed timeline, and you'll get a copy of this after our presentation. And with that, I will turn it over to you, Terry, to talk us through some of the personal side of that timeline.
We'll start with tax, what everyone loves to talk about and nearly impossible to avoid. So when selling a business, oftentimes we get hung up on the top line number. What is the value of the company? What can I sell the business for? And that's very important. But at the end of the day, as the owner of the business, your main focus is really what's going into your bank account at the end of the sale. So what are your after-tax proceeds after going through this process? So depending on how how the transaction's structured, what type of entity, that can all make a huge difference on the ultimate tax rate you're going to pay on the sale. Because I can tell you, if you sell your business for, let's say, $10 million, you're not walking home with $10 million by the day. There's a big chunk of that that's going to go to the taxing authorities. The tax rates typically for, that you're looking at for a sale, the goal is to get things to long-term capital gains rated if all possible. So that would be 23.8% at most for federal. And then if you're in a state, I'm in California, our rates go up to 13%. So it's a very high tax state. Other states, they kind of range anywhere from no income tax all the way up to the 13% range. If portion of the transaction is subject to an ordinary tax rate, that's federal rate of 37%. So you could have portions of this transaction taxed at over a 50% rate, which can be pretty high, and it's important to plan things in advance so you can minimize the tax rate you're paying on the sale. So when looking at, when you're preparing for a sale or thinking several years down the road, is my business ready for a sale from a tax perspective? You want to look at, first of all, what type of entity type is the company? Is it a C corporation, S corp, partnership, or sole proprietorship? Each of these have different tax impacts and can be quite different. Oftentimes when a company will start, they'll set themselves up as a C corp. It seems easy operationally to have a C corp. Everything runs through the company. The corporation pays the taxes, and it's fairly simple. But when you get into selling the business, that can actually be one of the least desirable entity types, because there's something called double taxation. So corporations, they pay tax at the corporate level, then they distribute out all the proceeds after the sale of the business to you, then there's a tax on the dividends. So in that case, you could wind up easily with well over 50% of the proceeds going to the government, which is probably not the desired result. The opposite is, you want single layer of tax, and that would be partnership or sole proprietorship. Typically, those are most likely going to be single layer of tax. There's something in between called an S corporation, and this often works. This works really well if you've been an S corporation for a long time. Most likely, you'll be dealing with single layer of tax. But one of the issues with trying to plan right before a transaction, you say, I'm going to sell my business next year. I'm going to convert to an S corp and start getting that single layer of tax. Well, the IRS has caught on to that, and they do have rules for corporations that have converted to an S election. You have to be an S election or S corp for at least 5 years to not be subject to any taxes on your C corp era values. So that can definitely throw people off. And if you start thinking of an S corp too soon before a transaction, you may really not save a lot by making that election. But doing it well in advance, such as when you start your company, it can be a lot more meaningful to saving on the transaction. Something else just to throw out there that could be an advantage with a C corporation, there's a concept called qualified small business stock. That only applies for C corporations, and potentially you could exclude up to $10 million of the gain from the sale of the business. So that's only available for C corporations, but something, potentially chat with your tax advisor and see if your C corporation could qualify. Also looking at, in addition to the entity types and what's the optimal entity type for selling the business, you want to look at what type of deal it is. So you get your LOI, and the company and the buyer says they want to purchase the assets of the business. But that's very different than they want to purchase the stock of the business. You can often avoid the double layer of tax with a C corporation or S corporation by doing a pure stock sale. But oftentimes buyers are not going to want to pay as much for in a stock transaction as they would buying the assets of the business. So it's understanding kind of the difference between the two and how they could affect single or double layer of tax is going to be really important, and also help you negotiate with the buyer, so that way you can ultimately maybe not minimize the tax, but maximize what you're, maybe you can get a higher value if you're doing higher purchase price if you're doing an asset deal. So you may pay more tax, but ultimately your after-tax proceeds could be higher depending on how good of a negotiator you are. So kind of going through the process of selling the business, and that's assuming that you are going to either sell to strategic buyer or sell to your family member. There's the other option of gifting the company. And this, could be a fairly simple way to go if you have a family member that you're interested in gifting to. So one of your children are doing really well managing the business and you want them to take over, but not have to buy the business from you. This, unfortunately, it doesn't necessarily come tax-free, although it may be much more tax efficient than selling the business, depending on how valuable the business is. So with gifting, there's the lifetime gift and estate exemption. And that means during your lifetime or after death, for a single person, you can gift away or leave to your heirs up to $12.9 million. For a married couple, that goes up to $25.8 million. So if your total estate as a married couple is less than $25 million under the current law, you could gift the entire business, basically gift tax and estate tax free. But let's say the business is worth $100 million, then anything over that lifetime exemption is going to be subject to a 40% tax rate. So if you want to gift a $100 million business to your child, you would have to be comfortable paying a very large gift tax, or only gift a portion of it, maybe sell the other portion. There's a lot of different strategies for accomplishing that. So, a lot of what we do kind of in the estate planning world is thinking about the different types of trusts out there. So you may want to gift 20% to your child, and what type of trust structure is going to be the most tax efficient, while also having certain restrictions, so that way your child can't, they get 20% of the business, they go off and sell it. That may not be what you have in mind. So there's a lot of creative options with and ways to hopefully pack in more of that company into the lifetime exemption. So definitely something important to work with your CPA and then estate planning attorney on. Right. In addition to the tax part, so we often like to let the tax tail wag the dog, which is not super helpful when you're thinking of overall financial planning, because sometimes what may be good for tax purposes may not accomplish your goals. If you really don't want to pay any tax on this, your business is worth less than $25 million as a married couple, gifting to your children may make a lot of sense, and you're not paying the IRS and your state tax authority this huge capital gains tax. But the problem is that really going to accomplish your retirement goals and your overall lifetime goals? So, thinking it's important to work with a financial planner that can do some modeling to see what are the cash flows you need for the rest of your life. So how much are you going to need annually to support, whether it's to support your philanthropic goals, your travel goals? Do you want to buy a fancy new car every year? Do you want to do a big home remodel? All of that's going to be important when you're thinking of how are you going to fund your retirement. And maybe your business was so profitable while you owned it that you have enough saved up that will fund your retirement. So whatever you sell your business for doesn't really matter for sustaining the rest of your life. But you may be, on the other hand, you need to get a certain dollar amount for after-tax proceeds for the sale just to fund your retirement. And in that case, going the gifting route may not make sense, and it may make more sense to sell to the next generation rather than gifting. So super important to go through a cash flow modeling process. That way, you're secure for the rest of your life and ultimately accomplishing the goals that you have. All right. With that, I will pass it over to Hans to talk about some key strategic questions.
Thanks, Terry. Appreciate it. So strategic questions are really questions you should ask yourselves in preparing the company optically for a sale, and working with your banker, your investment banker, or if you market the company yourself, working yourself on essentially developing a storyline why your company is an attractive target for the incoming owner, be it a family member or be it a outside buyer. Jesse, may I take a few points in the beginning?
Yeah. So I think when I think of some of these key strategic, we mentioned some of these on the operational transitions before, right? When I think of the key man risk, right? We talked about you're the owner, you're the governance, you're the HR, you're the dispatch, and as a buyer, they're going to say, okay, hey, you sell this company. Like, what happens when you're removed from this equation? How much is this business anchored to you? How much are your customers anchored to you? And to the extent you can try to create some disconnect between the fact that, hey, like I've developed this organization and a team of management who can run this organization without me, that helps create more value because your company can live and sustain and continue on without you being the primary driver. I think of what's your strategic advantage? Like that's your secret sauce. Like what is it that makes why do they want to pick up the phone and choose you to haul their goods compared to your competitor or someone else down the way? Is that going to be a technology enabled an advantage that's there? And really understanding how you're going to differentiate yourself from all the other truckload carriers maybe that are out there that you're working against, and how can that special sauce be connected to your buyer? And this goes to synergies, like who are you going to sell to? Is it a strategic buyer where maybe they do a lot of business for one of the same customers that you do quite a bit of business of, and by folding you in, they now have a greater percentage of that vendor or customer's goods that they're moving. So there's synergies there that they can fold into. Or I think I mentioned before, you're in a geographic area where this place really wants to be. They need a terminal or a warehouse in this location. They need trucks are hard to get. Drivers are hard to find. Maybe you have all of those items in that geographic area. And what type of synergies can you bring to your buyer? And so some of these questions, it starts to think of, you have to kind of know, how do I want to ownership transition out, right? Is it going to be through a sale to a PE firm, a strategic buyer? Is it going to be a transition out to family members, to key members of management, like we talked about earlier on? And understanding what your transition options are will drive these important questions, and how to capture those, to show those values whenever you work with your investment banker, to kind of show that your value proposition and create that what's that future cash flows that you can generate to kind of create today's value for that buyer, and that you can, and then demonstrate the fact that you can execute on those programs. So those are to me are these key strategic questions, and it's all just related to of knowing how and who you're trying to sell to, and understanding your business and operations, and kind of the culmination of a lot of the stuff that we just have been discussing.
I find market timing always a really interesting topic, because it's market today is something that everyone knows. I mentioned that earlier, but market timing is interesting because if you're selling into an upswing in the market, it's usually easier to show performance improvements in cash flow, and you also spark the imagination of the buyers in terms of income potential. So again, it is a lot about perception of income potential, future income that the company has, that you need to work with. And that is generally easier to do in a rising market than in a declining market. Funnily enough, we oftentimes find carriers being more inclined to sell in a declining market because it's tough, but it's actually much better to sell into a rising market from a market timing perspective. Opportunities to bridge.
Well, sorry, yeah, sorry, Hans. I think of over the past 12 months ago, right? Was an incredible time for transportation companies, truckload carriers, and what I was seeing is the buyers were saying, okay, we just came off 10 months of kind of just unprecedented stuff. Like that's not gonna, like that can't last. It's just this time period. And so, understanding that like the real drivers of trying to say no, that hey, this is we as a supply chain and as a consumer went from being more driven for a direct to consumer, delivered at my home type of supply chain, and that we fast forwarded 10 years. And so, yeah, we ramped way up high, maybe above what the norm is. And we're going to come back down, but we're clearly not going to come back down to like what it was beforehand. Like buyer pattern has changed so much, and understanding like that, again, market timing and how to communicate, understand, and like, again, being confident enough and understanding that to be able to tell the story that, this is, there is a bit of a one-time thing here, but this, we think from an industry standpoint, this is going to continue forward, and having understanding, again, what's going on and being able to communicate that. When you mentioned market timing and going up, made me think of that, Hans. So
yeah,
had to share.
No, absolutely. And technology can play an important role in that, because that's where the shifts happen, and you can build more competitive edge in, for instance, in a direct-to-consumer supply chain. Absolutely. Opportunities to bridge pricing gap. What happens if you don't get to the price that you hope to achieve, and how can you bridge it? The most common mechanism that you see is earnouts, right? How would you deal with an earnout scenario where part of your sales proceeds are contingent on the business achieving certain milestones after the closing of the transaction? And maybe that's while you're still involved in the business, running the business or parts of the business. So earnouts are interesting tools. They're tough to realize in real life, and oftentimes they don't happen. But it's something, if you really want to move ahead with a transaction, it's a tool that can be something to bridge it. I'm not sure if Jesse have any thoughts on that, or even Terry from a structuring perspective.
Yeah, I'll just say with earnouts, I've seen quite a few clients not actually get their earnouts. A handful do, but they are generally not easy metrics to hit. So when you're thinking at least through like your financial planning, want to think through whether you should actually rely on that for your, funding your retirement, or whether that's just kind of extra money on top.
Good. Thank you. Yes. And then wanted to share a few things. We talked about technology, and as BeyondTrucks, we are a technology company actively working with trucking companies, oftentimes in that generational transition, on digitizing and automating and future-proofing their business. So one of the interesting things that we see is, from a buyer's perspective, technology and technology stack is really tied very closely to how risky is this income that I'm projecting, to how much risk is that exposed. And I'm going to give a somewhat oversimplifying analogy, but if you were a retailer 10 years ago trying to sell your retail chain, you certainly had to worry about Amazon and the Amazon effect. If you were a hotel owner, you had to worry about Airbnb, and if you were a taxi company owner, you had to worry about Uber, right? So while trucking is very different, I think basically today every company is a technology company in their own right. So if you look at the ability to sustain income levels or grow income levels, that is going to be particularly questionable if we see massive technology changes at the horizon. And in trucking, we've seen that. We've seen it in the brokerage, on the brokerage side. We've seen it on the shipper side, and we now start seeing it on the carrier side more and more, where the type of data infrastructure, the type of software that you need to run a smart trucking company is radically changing. What we also see is that some of the established names in the industry from an architecture perspective are not particularly nimble to keep up what's required and to be cutting edge. So that's an additional thing where when we look at TMS technologies, we oftentimes have to replace them entirely, because we know that in the context of new energy sources or autonomous driving, the tech stack may not be able to keep up. So what does it mean precisely for you as an owner? I think you should ask yourself the question, does the technology that you use currently actively drive value in terms of revenue? Can it allow you to improve revenue? Does it allow you to dynamically optimize your dispatch? Does it allow you to pull real time on all the data points that you need to understand in your operation to improve your business? So for instance, do you get a fuel report at the end of the month, or do you get a financial report to understand the health of your situation? Or can you actually pull that real time to understand whether you should take a load, whether you should bid on a lane, or whether you should take that load and then hand it over to your brokerage versus your own fleet? So getting access to real-time data to make decisions, smart decisions, is becoming increasingly important. The second thing that we find often is, does the technology actually help you reduce costs? And it goes to one of our pet peeves, which is most of the technology that's out there today has been built to facilitate data storage, but not necessarily workflows. We, on average, find about $10,000 per driver per year embedded in poor workflows and pure processes. It's particularly high. It's typically 15 to 20K per driver in larger fleets where you may still be running on an on-prem system, where you still be running on an AS400, where you still may be using lots of Excel spreadsheets or paper forms in many instances to run your business. And these tools that you use have not only a direct cost, but have a huge indirect cost on your business because they create room for human error. They create room for sometimes cybersecurity issues. They are creating issues around visibility, or they may undermine your driver retention or your customer retention. So technology is really important in eliminating cost. I always say, if we find with one of our customers that there's $20,000 per driver hidden in indirect cost because of poor technology choices, at the 4x multiple, that translates easily into $80,000 in value per driver in your company. So once you multiply the cost savings by the EBITDA multiple that you see in the market, anything you can chip away from on your cost side by the use of technology will be amplified in the sales process. So it's really, really important to keep technology as in your quiver to get the company ready for sale. Funnily enough, we actually do, as a technology company, we oftentimes work with the buy side, with the buyer, to unlock these efficiencies. And then it is obviously questionable whether you as a seller want to leave that money on the table or actually and have the buyer do it, or actually if you want to capture it before the sale by implementing cutting edge technology. And I'm going to pass on the baton back to Terry, who has it. And maybe some closing thoughts, or Jesse.
Yeah, I think we're to the Q&A portion. So I think Amy has been watching the Q&A piece, and so I think we're going to cover some Q&A, and then at that we'll come back to get some closing thoughts.
All right, sounds good. Yeah, we do have some time left for Q&A, so let's start with these. So the first one is, Terry, you mentioned philanthropic goals as part of financial planning. Is there a way to incorporate charitable giving into the actual transaction and reduce the tax burden?
Yeah, good question. So that definitely you can incorporate charitable giving into the transaction. So there's a couple of ways of doing this. Some people may take the after-tax proceeds and then donate that to charity, and then ultimately lower their tax liability for the year. So if you sell your company, let's say for $10 million, and then you want to set aside $1 million to go to like a donor advised fund or to your favorite charity, you could do a cash donation after the transaction is closed and then lower your overall tax liability for the year. There's also possibility of donating stock in the company prior to the transaction. So that has a lot of complexities to it. So, you want to typically avoid donating it to like a private foundation, making sure it goes to a public charity, and then will the public charity even accept stock of a private company? So while it is possible, and that could be a good way for tax savings, there's just some complexities involved with that. And in addition, there's some other options like putting the company or a portion of the company into a charitable trust prior to the transaction, which can then give you some income stream after the transaction, in addition to an amount going to charity, either at the front end or back end of that trust, depending on how it's structured.
Nice, thank you. Let's see, Hans, technology is a big expense. How can we determine if it's worth it to switch, especially if we're thinking of selling the company?
Yeah, very good question. I think it's important to not only to look at price, but really to ask your providers to quantify the value they generate. Technology should provide you at least a 10 to 20x return on your technology investment. So I would be very discriminating with your providers to work on that and quantify the value it can bring. Again, if you invest in the technology, part of that improvement in efficiency through digitization, through automation, can be amplified through the multiple in your sales process. I think it's always smart to do it before the sale and not leave that money on the table for the buyer, but capture it as a seller. So that would be my recommendation. Be very value focused and challenge your vendor.
All right.
Hey,
Looks like we have another one. Oh, go ahead.
Fine, Terry, as you were talking about some entity structures, and as we're waiting for some more questions to come in, I think there might have been some more. Amy, sorry to cut you off there. Is there an entity structure that you see as being more favorable or works best with asset-heavy type companies where they might have warehouses or trucks and things of that nature that provide for a more favorable exit strategy versus another type of structure? Like, can you speak to that or have any thoughts?
Yeah. So in the tax world, the answer is always it depends. For like a C corporation, if the company could be a qualified small business stock, you can have some favorable tax treatment when you sell, and that's not available to the other entity types, including S Corp, LLC, or like a sole proprietorship. However, like a lot of times it's good to, even if you have the operating entity, a C Corp or S Corp, keeping real estate outside of the corporate umbrella is usually advised. There may be reasons to keep it inside the corp, but oftentimes we'll see, an LLC partnership that, the corporation rents the space from, just because if you ever want to distribute the appreciated asset like a warehouse outside of the corp, it can be very ugly from a tax perspective. So yeah, it kind of depends, but generally real estate type of assets are better to keep outside of a C corporation or even an S corporation. Jesse, we can't hear you.
Jesse, I think you're on mute.
I'm just going to cue. Yep, I'm just going to cue that we're at the top of the hour. So I think if there's more questions that have come through, we'll make sure we respond to those offline and send those out with the inclusion of the materials that we'll send to all the participants. We thank you so much for your time. Appreciate the time that you took for us to learn about how technology can enable a successful transition to you in your process of selling or that next step, as well as hopefully you learned some helpful tips on some personal tax side as well as on the accounting side of your company as you prepare for that transition. And with that, I will pass it to Amy to give any kind of closing thoughts from them.
All right. Thank you, Jesse, Terry, and Hans for a really great presentation today. I also want to thank our audience for being engaged and submitting your questions to help guide today's conversation. Feel free to reach out to our presenters if you have additional questions. Their contact information is in your console. Also, please drop a note in the Q&A window if you would be interested in another webcast on this topic. And you can also let us know if you would like to set up a separate call to discuss this more in depth. And finally, here's a link to an online survey for today's presentation. And thank you for joining us. Take care, everyone.